turns out that President Trump may be trying to fire the Federal Reserve Chair Jerome Powell very soon here. Now, it's no secret that ever since the inauguration, Trump has been pressuring the Fed and specifically Powell to lower rates. He's been posting about it constantly, calling him names like Too Late Powell, and saying whatever he thinks he needs to say to get Powell to lower rates. But recently, a scandal about how much the Federal Reserve has been spending on renovations at the Federal Reserve's building could give Trump the ammunition he needs in order to fire Powell. If you don't remember, months ago, Trump actually looked into whether or not he could fire Powell, and due to policy reasons, it was pretty much a straightforward answer: no, you don't have the authority to remove him. However, with something like this used as the scapegoat to remove Powell, it might actually work. Apparently, the Federal Reserve has spent $2.5 billion on a renovation plan, and Trump told a reporter that he thinks it sort of is a fireable offense, specifically because it seems that Powell may have lied to Congress when he said that the renovation would not include some of the upgrades that were described in the official plan documents that came out in 2021, which included things like Italian beehives and new marble finishes. Now, if you see something like that, and it kind of shocks you a little bit that a government or quasi-government, quasi-private building would need to have such ornate finishes, then it's probably just because you aren't familiar with how the Federal Reserve operates. It is outside the economy. It doesn't rely on taxes. It doesn't rely on profits. It doesn't need to generate revenue from sales. It is the entity that creates the money. It spends what it wants and needs to spend because it doesn't need to give anything of value whatsoever in order to get that purchasing power. Now, you might think, hey, well, that's just the government overall, but even the government at the end of the day is full of people who are at least appointed by elected officials who have to win votes. That does not exist at the Federal Reserve. Good times or bad, recession or boom, the employees at the Federal Reserve sit on their nice salaries doing their little research. It is the largest employer of economic PhDs in the world. They take their breaks, they clock out, they don't get their perks cut when the economy is down or the business is struggling. That does not exist for the Fed. So seeing plans for upgrades like Italian beehives and new marble finishes should not be surprising. Okay, but getting back to Trump firing Powell specifically to try and get rates lower, it's not clear that this will actually accomplish the goal that Trump thinks it will. Because as of right now, the yield on the 30-year US Treasury has breached 5% yet again. The 20-year has also breached 5%. And the 10-year is looking dangerously close to a breakout that could also get it back up to 5%, which it briefly touched in October of 2023. Now, because these long-term interest rates are so high, the US government has not been issuing a ton of debt at this maturity. There's simply not enough liquidity in the markets, not enough lenders and money willing to lend to the government for that length of time at those high interest rates. And so instead, for years now, the government has been rolling over all of its debt that's been maturing into short-term debt, T-bills. Debt that matures in under 2 years, usually under 1 year. Now, it's not like this debt has that much of a better interest rate. A 6-month T-bill is yielding 4.2% right now. But the idea is that it's constantly rolling over, which means if those long-term rates get to go down at some point soon, then when all of that short-term debt then finally matures within the next couple of months or the year, then they'll have all that debt that they can refinance into longer-term debt once those interest rates are lower. They don't want to lock up long-term rates for 10, 20, 30 years right now when they're still so high. And Trump has committed to rolling over basically all the debt that matures into short-term T-bills until interest rates go down. One of the reasons why he's been pressuring Powell to lower rates. But taking a look at the federal funds rate, we can see what happened last time the Fed lowered rates leading up to the election in 2024. The Fed lowered the Fed funds rate, which is the interest rate it controls, from an effective rate of 5.3% down to 4.3%. That happened from August of 2024 through January of 2025. However, if we look at what that did to long-term interest rates, it took those long-term yields from 4% all the way up to 5% over that exact same time frame. So the Federal Reserve lowering rates, the one rate that they control, which is the Fed funds rate, actually had the impact of increasing interest rates for that longer term debt, which means even if Trump is able to convince Powell to lower rates, or even if he's able to fire him and replace him with somebody who is able to convince the Fed, hey, yeah, we should lower interest rates, it's not very clear that it will even have the impact Trump is looking for by getting those long-term rates lower. In fact, it's very likely it has the opposite effect and pushes long-term interest rates much higher. Now, the reason for this is because we are in a new phase of the long-term debt cycle. It's not 1980 through 2020 anymore. Now, inflation is out of the bag. The time period we're in right now with debt to GDP above 120%, inflation rising instead of inflation falling, things look much more similar to the way they did from 1940 through 1980, which means that when the central bank, in this case the Federal Reserve, lowers interest rates, they're lowering the short end of the curve. That means temporarily more spending and borrowing from the government because they can borrow more T-bills for much cheaper. They can't borrow those long-term bonds for cheaper, but they can certainly do so with T-bills. All of that extra money injected into the economy means prices are going to go up, and lenders understand this. And so no lender is going to lend at a lower rate, understanding that their purchasing power is being eroded by inflation, which is why you get long-term rates actually go up, because those long-term rates, as of right now, are still at least partially controlled by free market influences. People buying and selling those bonds. So if you know inflation is going to go up because you know money is being printed and spent into existence, then you're going to demand a higher interest rate on those bonds that won't get paid back to you for a lot longer, which means this is the only solution left. The Federal Reserve's balance sheet is going to have to go up again. In other words, they're going to have to start quantitative easing. The only way to meaningfully and significantly get interest rates and yields on those long-term bonds low enough to where the government can roll over $9 trillion of debt into long-term bonds at a low interest rate is for the Fed to buy those bonds themselves. There's just not enough money and no willing buyers in the system to take that place because bond yields move as a result of the supply and demand of the bonds themselves. So you need a huge buyer to come in and buy up all those bonds that the government is issuing. You need them to do so in such large size that not only do interest rates not get spiked from that, but they actually stay low where the government wants them, which means whoever replaces Powell, if Trump is able to fire him, won't need to just lower interest rates. They'll also need to restart QE to a huge extent. Now, I've made a few videos over the last couple of weeks about the other things this administration is doing right now in order to try and get interest rates, especially long-term rates, down. One of them is the stablecoin legislation. Stablecoin legislation is to make sure that the stablecoins that exist and are being spread around the world ultimately are invested in treasuries. That's extra treasury buying demand. Problem with that, a lot of it is at the short end. A lot of that is T-bills. We also see the Treasury General account being refilled by Besant. That could force another liquidity injection by the Fed. But again, that's just a short-term stopgap. We see the proposal in Congress to make the Federal Reserve stop paying interest to banks on the reserves they hold at the Fed. That would force a few $1 trillion back into treasuries. But again, a lot of that's going to be T-bills, and it's only about $3, maybe $4 trillion or so. It's not the $9 trillion plus that the government needs. We also see a push to deregulate the banks, and that could allow much more demand, but also that comes with its own set of politically unpopular opinions. Again, just deregulating the banks to let them buy more debt. And so because all of these together seem like they're not going to be big enough and they're just temporary measures, it does seem like the Federal Reserve is going to need to start QE again in order to get the full measure of long-term rates low enough in order to absorb the full demand of debt that the government has. We've got an insatiable appetite for borrowing, and somebody needs to buy the bonds that they're issuing. Now, we've seen this playbook play out many times throughout history, that eventually, when you get past that 120% debt to GDP ratio, you get countries, central banks doing things like yield curve control, debt monetization, and the central bank really becomes the only or the most significant buyer of government debt, which means it's not actually debt. It's just called inflationary financing. It looks like debt, but because the government owes it to the central bank and the central bank sweeps profits back to the government's just really printing whatever money is necessary in order to cover the deficit. In short, expect inflation first in asset prices and then in goods and services. And even if the Fed lowers interest rates, even if that impacts interest rates for you and I for a very short amount of time, it won't last long. So if it does push things like mortgage rates lower, take advantage while you can. Now, if you are not prepared, your portfolio is not protected from the volatility that this is going to cause in markets, and you are not prepared for the asset price inflation properly allocated across uncorrelated classes of assets, you need my hypergrowth portfolio blueprint. I give you a step-by-step guide in order to prepare yourself, number one, to profit off of everything that is happening right now, but also to protect yourself against that downside volatility that happens in markets that are inflated artificially from a bunch of money printing. If you don't have it already, get it with the link in the description below. As always, thanks so much for watching. Have a great day.